Hello, friends. Welcome to Surviving Tomorrow, a podcast, newsletter, and publication that helps you navigate life in an age of democratic destruction, ecological collapse, and economic irrelevance. Available for free on Substack, Spotify, Apple Podcasts, Facebook, and YouTube. I'm Jared Abrock. One of the big stories this week was that Tesla just hit $1 trillion market cap. Trillion with a capital T. That's a 1 with 12 zeros behind it. Things are so crazy right now that Elon Musk's net worth grew by $36 billion in a single day. To give you an idea of how big $1 trillion is, if the company was a co-op, each of Tesla's 70,000 employees would be sitting on a $14 million fortune. But of course, Tesla isn't a co-op, and it isn't worth $1 trillion. It isn't worth a tenth that much. What is Tesla actually worth? That's what we're digging into today briefly. To Tesla's credit, unlike the past 4 years, the company actually made a small profit in 2020. How they managed to do that amidst COVID probably is baffling to a lot of people until you realize that that profit was almost exclusively derived from Bitcoin being high and corporate socialism in the form of government handouts. The thing is, their measly $3.4 billion in not selling real products profits doesn't remotely justify a $1 trillion market cap. We need some context here. There's something called the price to earnings ratio, the PE ratio. It's considered the benchmark number for comparing one company's stock price to another. The PE ratio is based on the current stock price divided by the trailing 12-month earnings per share. So if a stock is $10 a share and the PE ratio is 10, it means that the company is earning $1 per share. If you buy a $10 share with a PE of 20, it'll take you roughly 20 years to break even. To give you an idea of what normal PE ratios look like, Warren Buffett likes to buy stocks with a PE of around 12. The S&P 500, which is the biggest 500 companies in America, their long-term median PE ratio is around 15. The S&P 500's current PE ratio is around 29, nearly double its century-long average, despite the pandemic, which I don't know if you agree with this, but most people think that means #bubble. Apple's PE is typically around 30, which is pretty reasonable considering this market, and Amazon's PE hovers around 60. Tesla's PE ratio, by contrast, is currently over 330. That's $1 worth of earnings for every $330 invested. Would you invest $330 to make a dollar? Would you really buy a business with an ROI of 0.003%? To put it another way, would you acquire a company that would take over 3 centuries to break even? Most rational people would say no, not in any world. But this, of course, is where you have to cue the irrational fanboys who scream, but Tesla's future potential is huge. To which reasonable people would say, sure, but not compared to its current price. To fall in line with the S&P's historical averages and provide a reasonable rate of return, Tesla would need to 22x its current earnings to nearly $75 billion, which is nearly 4 times Amazon's profits last year. Do you understand that? To have a reasonable rate of return, Tesla would have to make 4 times as much profit as Amazon does, 22 times its current earnings. To provide a 10% annual return on a $1 trillion market cap, Tesla would need to 29x its current profits. It's just not going to happen. Versus last year's profit margins, that means they would have to create over $3 trillion in annual revenue. That's nearly 6 times more revenue than the largest revenue earning company on earth. It's just not going to happen. I like to call this double bubble trouble. Objectively, Tesla is wildly overpriced, even compared to the overall market bubble. It's a double bubble. It's the overall market bubble plus the Elon Musk fanboy story stock bubble. Tesla may very well be 11 times better than the average S&P company right now, but that just means Tesla's price bubble is just that much more inflated once you scrub out all of the irrational exuberance. Let's run a quick back-of-the-napkin comparative analysis. If Tesla traded at the same PE ratio as Amazon, arguably one of the strongest companies in the world, Tesla's market cap would drop to $178 billion, less than a fifth of what it's currently trading for. If Tesla traded at the same PE ratio as the Volkswagen Group, which includes Volkswagen, Audi, Bugatti, Bentley, Lamborghini, Ducati, and Porsche, Tesla's market cap would drop to 25 billion, about a 50th of its current value, 40th. If you compare Tesla to Apple, which is a fair comparison and a far more rational PE ratio, Tesla's market cap drops to 90 billion, about a tenth of what it's currently trading for. Now pop the overall asset bubble, and Tesla's true market cap is realistically somewhere less than $50 billion, about a 20th of what it's trading for right now. So what's going on here? Honestly, I think it's just gamblers in a dangerous time. As a sound investment, Tesla is one of the worst stock picks in the world, but as a fun gamble, it's clearly one of the best. And just like Bitcoin, small investors are going to lose hundreds of billions of dollars when the price bubble pops. Because let's face it, Tesla is a meme stock. Just look at who's buying shares. It's almost a direct correlation in the growth of Robinhood users versus Tesla ownership and Tesla share prices. It's young bucks. And most of these men are probably buying most of their stock on margin. Either way, Tesla stock is clearly being pumped by unsophisticated investors who haven't done their due diligence regarding the company's actual long-term worth. What's interesting is they don't even care. The end result is that tens of thousands of Tesla speculators are going to lose their life savings. In no rational world is Tesla worth $1 trillion right now. But of course, we don't live in a rational world anymore. Because the productive economy is dead, the only way to make big money without having to do any real work is to play an extraction game, getting in on Ponzi schemes like real estate, the stock market, or cryptocurrency, or Tesla, desperately hoping you can sell at the top before the whole house of cards falls apart. And it will fall apart. When it does, there will be riots and protests. There will be suicides. And millions of people will lose their jobs and homes and suffer untold hardship. As usual, the elites will pick through the wreckage and scoop up cheap assets at fire sale prices. We saw it in 2008, and we will see it again, but only on a bigger scale. The rich will do what they want, and the poor will suffer what they must. Thanks for listening to Surviving Tomorrow. Please share this episode by email and social media so we can grow our community of resistors. We are listener supported, so if you'd like to get involved, please visit jaredbrock.com. Thank you for listening, and we'll see you next time.